This is the Live at Lunch broadcast from the Resilient Advisor. My name is Jay Coulter, and joining me for this episode is Lenore Hawkins of Tematica Research. Your time is valuable. Thank you for tuning in. Here's what you're going to learn today. You're going to learn about Lenore's experience traveling internationally over the past 48 hours. We're going to talk about the economy. We're going to talk about the Fed. We're going to talk about inflation, and we're going to take a look at ISM, all through the lens of how it could help you as a portfolio manager. As with all broadcasts on the Resilient Advisor, please ask your questions. This technology is incredible. If you're watching on LinkedIn, YouTube, Facebook, or Twitter, simply type in a comment and we'll pose your questions to Lenore during this broadcast. Lenore, how are you?
A little sleepy, so I apologize to everyone if I get a little goofy here and there. I have not slept in like 30-some hours. I traveled from the west coast of the U.S. to Dublin, Ireland, which, I mean, it's always a long trip, but it's a lot more interesting these days when you're dealing with the coronavirus and having to wear a mask the whole time on a plane.
Walk us through it. I've had an opportunity to travel. It was from Atlanta to Cincinnati. It was on Delta, and it was a pretty smooth experience. Everybody had masks. Every center seat was empty. And they were very, very methodical about getting you on the plane and getting you off. That was my experience. What did you go through?
Well, it's really interesting because I've gone both directions. I was in the U.S. for 2 months. So back in early July, I traveled from Italy to Ireland and then Ireland to San Diego, and then just reversed it since then. I'll say, I hate to say this too, because I'm the super extra special platinum member on American Airlines, but American's doing a very different thing than Delta and United. American packs the plane. My flight this morning, or yesterday morning, I guess, from San Diego to Dallas was literally oversold. Like every single seat taken, and they were paying people $600 to take a flight the following day. And not only that, but American, I was blown away. And I was actually blown away by the airport themselves, that they didn't take more responsibility for this. So in Europe, I don't know what your experience was, but all over Europe, when you board a plane, they're very serious about boarding from the back and kind of methodically, and making sure that even during the boarding process, people are keeping their distance from one another. So when you're on the jetty, right, there's little stickers on the ground that's like, stop here, stop here, stop here. The American Airlines flights, it's like it's 2019. They just pile everyone in. Everyone's on top of each other. You know, I'm sitting in my seat like, okay, I'm going to die now, because there's all these people jammed up against each other and on top of me because they board, I'm like, I fly so much. So I'm, the group, I'm group number one. So I'm on the plane, and now everybody else is coming in, and they did not do the boarding from the back first. American, I not very pleased with them. But what's interesting is the difference between flying around the US, because those flights, like the airports are pretty full, the flights are fairly full, both coming from Dublin to Dallas and then Dallas back to Dublin. The plane, I mean, there's less than 30 people on the plane. Less easy. I mean, most big sections have like 5 people in it tops. It's nice because you're a little bit nervous. You got the mask on the whole time, but God, from an economic standpoint, that is so much business that's not getting done. And Dublin is doing everything it can to stay very open to the US, because Dublin is the tech hub for Europe, right? So it's got a very close, very tight relationship with the US. You go into like the tech center of Dublin, and you see, name every major tech hub or even biotechs, and you will see their names on big buildings. And yet there's no one on the plane. So that's not great.
So you haven't been back in Ireland that long, but what do you know about the economy there in Ireland? Is it started to open up? Are people doing business?
Yes, much more so than Italy. And I would say even more so than the US. The big debate right now, understandably, because it's Ireland, is a lot of anger about the pubs still having restrictions on them. But if you look around here, it's funny. It is actually one of the really strange things when you go from country to country. And I have a bias because I was in the epicenter of the pandemic, where it started in Italy. In February, I lived through the horrid lockdowns there. So I have a little bit of a different perspective on it than people say in Idaho, right? Who just didn't it's not really touched it. You really haven't seen it firsthand and experienced a real lockdown. Every country is really, really different about it. Italy's very serious masks and all that, but we had doctors and nurses dying, a lot of them dying in the depths of the pandemic. And I think with the population being a bit skewed older and a lot of families still living together, that's kind of a cultural thing. People there are a lot more careful. In Ireland, they're pretty opened up here. Business, like you see traffic at rush hour is just normal again. Going to the park, you see people, like, no one's wearing masks outside. They're wearing masks, say, on a bus, but just out walking around, they're not wearing masks. And the economy really is trying to get going here again. And restaurants are open and indoor dining is open. They're doing more separation, but it's getting back to business a lot faster than Italy is. That's for sure. It's I would say here it's still a bit tighter though than the US. The US was a little bit cultural, like kind of shock for me coming from Italy to go to the US and get there, and just the pushback on wearing masks, just living it firsthand was a little bit surprising, because I lived where it was, if you want to walk outside your front door, you have a mask on, period.
That's right. Yep. So it sounds like Ireland's a little bit more like Atlanta, Georgia, where I live, a little bit more open. From what you know about Italy today, we got to have a couple broadcasts and have you on and talk about Italy while you're in the midst of it. Do you know what it's like there today as far as it relates to the economy and people getting out and about?
So they're slowly getting it going, but they're a lot more afraid. It's funny. Part of this pandemic, I think, is really, it's not something you can easily quantify. It's more emotional. The economy is more locked down still today than say much of the US is. But a big part of that is not even official lockdown. I mean, some is, but not all of it. It's that so much of Italy's economy, about 13% of GDP, comes from tourism. And you weren't getting any. The big tourists are from Asia. The big money tourists are from Asia and from the US. That's where, like, if you talk to anybody in the hospitality industry, those are the tourists that they really want. This year, they only were getting other Europeans, and the other Europeans just don't tend to spend as much, because that trip for, if you're coming from, say, France, going to Italy, that's more like going from like Oklahoma to Texas. It's not as big of a trip. So you're not really going to be spending quite as much money. But what they did see, and this is what has getting Italy really scared again, is places like Sardinia. Sardinia is a little island. They didn't have really hardly any cases. When we got hit, when the northern Italy got hit really hard, Sardinia didn't have any. So then everybody started relaxing, and Italy's cases went down to where they were like 100, 200 a day. That was it for June, July, and then the August holidays hit. And now it's really ramping up again because people went on holiday. They were enjoying themselves, which, it's horrible that that's kind of like a finger wag moment now. I mean, getting together for a dinner party is like some sort of a reason to finger wag at people. But people came back and they were sick. And like even Berlusconi, the former prime minister, he was in Sardinia, went to a dinner party, and now he's got the virus. And that guy's up there a bit. So he's not doing so well.
Well, if you're a longtime viewer or listener to the show, Lenore and I did some broadcasts that were 45 minutes long, just talking about the challenges that came from all of the lockdowns. But Lenore and I, we really like talking about the economy, the markets. We like doing it with charts. Lenore loves charts, maybe more than I do. She brought a deck for the broadcast today. Let's start with your thoughts on TSA passenger throughput.
Yeah, it's I would have to say, though, Dallas was packed. So officially, if you look at the TSA numbers, which is a great way of getting an idea of what passenger traffic really is, because everyone's going through a TSA checkpoint. So right now, passenger traffic is down about 71% year over year. So, God, we're less than 30% of what you would typically see this time of year. That's pretty astounding. But it is up. This is the highest level we've seen since late March. So that's an improvement. But what we're seeing in TSA traffic is also what we're seeing in a lot of other aspects of the economy, which we're going to talk about. There was that crash Then there was a really nice pickup. And now we're seeing an awful lot of indicators sort of flattening out, and not flattening out at a great level right now. I mean, you look at this pandemic, we're dealing with rules constantly changing, where you can fly, where you can go, even within the United States, traveling from one state to another. Can you do it? Do you need a COVID test for you to be able to do it? And as a business, we've never had this level of uncertainty. What's happening with your supply chain? What's happening with managing your business? Where can your people go? Where can they not? Who's working from home? How long is that going to go on? Do they have childcare? Does their kid now, they want to come back to the office, but their kid's going to have to stay home from school, and that adds a whole nother complexity. So I think while the market is partying, we're not out of the woods.
Yeah, childcare is a big challenge. It's a big challenge in my house here in Georgia. It's a big challenge across the world. Let's switch gears and start talking about GDP.
Right.
You've got some great charts here. Walk us through what you're thinking.
So right now, this chart, just to me, talk about a gut punch. So this chart goes all the way back to as far back as the Fed was tracking quarterly GDP. And that red line, that's where we are today. You'll notice we've never come even close to that number. The economy is currently down about 9% year over year. That's the single biggest decline since the Great Depression. And while we'd love to see that V-shaped recovery, that's not going to happen for many quarters and possibly even years, because there's two factors here. One is getting the pandemic under control, vaccines, treatments, and all that. And there's just no way to know exactly what kind of pace that's going to happen at. And the other is the aftermath of such a massive, unprecedented hit to the economy, and what that's going to do to businesses, both from their bottom line, right? Like how much debt did they have to take on? How much of a hit was it to their asset base, right? So their ability to actually produce, what's their inventories look like? And also their employees, right? How many employees they had to lose, and what that's going to mean for them going forward. Everything is just a lot of the wheels of the economy have a lot of gunk in them, even when we get rid of this pandemic. So getting that going, and then add on top of that the burden of debt that's been layered on top. And this was already an economy that was really struggling under a lot of debt. And then there's a little demographic issue with the baby boomers. So this is not going to be an easy one. If we go to the next chart, looking at the Jeffries U.S. economic activity, because that gives you something that's a little bit more timely than GDP. The U.S. economic activity dropped nearly 70% by April. So we were operating at 30% of what the economy normally is at. And it's come up a lot, but we're really now about 60% of normal and kind of plateauing there. And a lot of that is because of those uncertainty headwinds, right? I mean, we hear these great headlines about employment, but they're not really given the full picture. And until businesses know, like, what's going to happen next month? No one knows, right? What's it going to look like in November? Are we going to have to go through some lockdowns again? Or maybe the virus is getting weaker. Maybe we get a vaccine that really works. A lot of uncertainty. And that is a killer for growing businesses.
Yes. And you've got one more slide on the economy. And then I want to bring this home for financial advisors, which make up the majority of this audience, and how you can take these thoughts you have on the economy and apply it to your portfolio construction. So walk us through the WEI and your thoughts.
Okay, so this is the Fed's weekly economic index, and it shows that the hit that we took to this was a lot more painful than the great financial crisis, which, we all feel like that was the worst thing that ever happened. And this makes that pale in comparison. And again, we rebounded, but it feels great only because we got hit so hard. And so it feels good now, but we're still well below where we were pre-pandemic. So then taking that all back to advisors and managing their portfolios, and we'll touch on this again when we go looking at the markets. Right now, there is an absolutely unprecedented just spread between economic reality and the markets, and that's driven by what the Federal Reserve is doing and also the fiscal stimulus, right? Those we're seeing unprecedented fiscal stimulus, which now we're in a holding pattern waiting for the next round. But what we did see, that was something you've never seen outside of a world war. And the monetary policy is also just, it's mind-boggling, the level that we're getting. And what that's doing is making price discovery non-existent.
Doesn't exist
right?
at all.
It's irrelevant. So we've really got, as an advisor, you got to know that what is happening with these asset prices is not based on any kind of fundamental value. It's more of a momentum game. And so we need to keep an eye on those momentum indicators. And we could be seeing, although it is anybody who tells you that they know, worry, right? There's
and that's the truth in any market, but especially now.
Especially this.
Yeah.
I mean, we have no idea. If I could say, well, this is what's likely to happen if we don't get additional monetary or fiscal stimulus, but we have no idea what kinds of new games they could pull out in the coming months, both domestically and internationally. And that also has a very big impact because it's all a relative game, right? When you're looking at currencies, for example, with the dollar getting weaker, I don't think that's going to continue because that's only happened because the Fed came out first, all guns blazing, and the European Central Bank has been a little bit slower. And I think that's probably not going to last. So that's really, there's always a relative game. Where is the money going to go? And so that determines fund flows. And that's part of that momentum game, right? Everybody's chasing to where they think everyone else is chasing to, and screw the fundamentals.
But I mean, momentum's worked. Trend following has worked here for this.
Yeah.
So, and valuation most certainly has not. Let's switch gears and talk about unemployment.
Right.
Give us your take.
So as you can see here, the unemployment rate, which is the pink line, it improved to 8.4%, and it had gone all the way down to 10.2% in July. So that sounds great. The labor force participation rate, that's the green line, it also improved. It got up to 61.7 from 61.4 in July. So that just means more people are coming into the workforce. That's a really great sign. People had panicked and kind of just stepped out of the workforce when things got really bad. And then the underemployment rate, which is the blue line, that improved to 14.2% from 16.5% in July. So these are all really good things. They're all improving significantly, but wow, still got a long ways to go. If we're talking about like last week, there's a lot of hullabaloo about the employment data that came out. So the initial jobless claims last week came in below the estimate. So that was great at 881,000 versus 950,000. That's fantastic. And it dropped below 1 million for the first time. That's great. And we've seen these initial claims have been falling sharply since the peak that was around the end of March. But we're still unbelievably high relative to what you normally have, right? Even the worst we'd had pre-pandemic was about almost a little under 700,000. And now we're excited if we drop below 1 million in 1 week. And if you take an aggregate of all the initial claims, we've hit over 59 million of initial jobless claims. And the continuing claims are still over 13 million. So that's a lot of people that are still not getting a job. If we look at what that means for magnitude, the total US labor force was almost 165 million in February. And if we look at the total initial jobless claims over the past 6 months, that's about 36% of the workforce. So over 1/3 have filed initial jobless claims. And we've never seen anything like that in such a short period of time. So those continuing claims are exceptionally elevated, which I think you just showed that continuing claims one. And if we look at, chart 7, while there was a payroll beat and the unemployment rate did fall faster than we expected, and wages were stronger than expected, and hours rose, but the number of Americans who are permanently laid off, right? Because we started thinking, the pandemic hit and everybody shut down, put the kind of economy in a bit of a coma. But it's going to be okay. It's going to be okay. We're going to get that V-shaped recovery and people are going to go back to work. Well, the number of Americans who are permanently laid off rose by over 500,000. And their share, those who've been permanently laid off, is about the same as it was during the peak of the recession in the early 2000s. So that's not saying V-shape.
service sector jobs, hotels, restaurants, travel. Are you seeing that spill over into any other sectors?
You've got, because think about all the ancillary to that, like retail, right? So you're not having as many people going into retail shops. So everything that supports the retail shops is also going to get hurt. All the manufacturing going back into that retail shop. Now, we are seeing nice things going on in, say, home improvements, because people are spending more time and deciding, I can't live with that couch one more week. But you're not really going out. Like, how driven are you to go get another pair of work shoes? I mean, we're all on Zoom. No one gives a damn about your shoes. You're wearing slippers or bare feet, right? There's an awful lot of things that with this new virtual work economy, people aren't going out and buying. And as we get a little bit more concerned with where the economy is going to go, I think that spending is even going to contract even more. And when that, as we see an uncertainty rising with the employment, right, because there was that hope of like, well, V-shape, right? Okay, it's bad for a couple months, but then everybody's going to go back to work. Now it's like, oh, not everybody's going back to work, and this may actually drag out a lot longer. And now I'm worried, so I'm not spending.
As an aside, Lenore, I have not been to the dry cleaner. This occurred to me this weekend all year. I put this shirt on to do broadcast, and then I hang it up.
No, exactly. What do I need with work shirts? I mean, you can get away with an awful lot, right? Because it's not like you're going to the office and there all day. And
that's right.
As much as I love my Jimmy Choos, I don't need them on Zoom.
Oh man, let's get back to the charts here. So, walk us through what your thoughts are on the markets now, and I'm giving you that softball. You can take that anywhere you want. Okay.
Well, it's interesting, to put it mildly, isn't it? We're seeing things that we've just never really seen or rarely ever see. For example, last Thursday was the first time in over 20 years that the S&P fell more than 2%, when the day before it had hit a new record high. The last time we saw something kind of crazy like that was May of 1999. Not a great year. Thursday was also the worst day that we've had since June 10th. But it has the S&P. I mean, really, it hasn't been hit that hard. And I'm speaking as of Friday's close, not taking today's movement into account. The S&P is now just slightly below overbought territory, and it's still about 9% above its 200-day moving average. And that's about 3 times where it normally sits, at about 3% above its 200-day moving average. So that tells you that we have a market that's still priced for a lot of optimism. Kind of amazing to see that when there's so much uncertainty out there. And that goes to what we were saying about price discovery, just not really there. We have had a 35% gain in the S&P over the 5 months from April through August. And that's the best 5-month run that the S&P has had since August of, get this, 1938. The last time we had really, really, really bad economy hits. Yeah. And while the S&P has been impressive, the NASDAQ, oh my God, the NASDAQ 100 has been incredible. It is today 22% above its 200-day moving average. And we had a decline of about 8% over last Thursday and Friday. And just 2 days ago, the index was over more than 30% above its 200-day moving average. And we haven't seen this kind of just outperformance and just drastic moves since the .com boom. So we're in a situation where the index would have to drop a full 20%. I mean, that'd have to be into bear market territory just to hit its 200-day moving average. That's not a normal market condition. And again, this is at a time where uncertainty is at a level we just really haven't ever seen.
Mm-hmm. Well, so one last chart. See, I'm getting fancy with this.
You are. I like it.
Right? I just I'm learning as we go. All right. Here we go with the Bannock gold miners interloped with some of the other sectors right now. And a great chart to end on because it speaks about the dispersion in the sectors. And then let's bring this home for financial advisors who have to build portfolios and manage money for clients.
Yeah, so here we've got gold miners. I was looking at gold miners and tech performance relative to energy and banks. I mean, we're talking, this is some like over 60 to over 80% outperformance so far this year. Gold outperforming that, gold miners and tech outperforming energy and banks that much. I mean, that is something we've never really seen before, and just speaks to how this is such an unusual market. And that is part of what makes this market so challenging, because there's no playbook for the economy, and there's certainly no playbook for the markets.
All right. So there's the setup question for you, Lenore. There's no playbook for the economy. There's none for the markets, but financial advisors are still building portfolios for their clients without giving advice, without telling them what to do, because every portfolio and engagement should be customized for the end client.
Absolutely.
But what do you need to be thinking about, since there's such a disconnect between the economy and the markets?
Right. I think you need to watch sentiment more than anything, fund flows more than anything. Look for where there's perversions in how the markets are functioning. I'm sure we've all read about what's going on with soft banks and the put call ratio and how that's gotten out of control, right? We want to keep an eye on, wait, this doesn't look to make sense. For example, like if you look at the high yield market and you look at what high yield bonds, where they're trading versus their long-term normal versus the default rate, that's also completely out of whack. So these are all things that are telling you the market is not pricing risk appropriately, right? It's not pricing risk appropriately. It's not really pricing. If it's not pricing risk, that means it's not pricing the value of money, because if bond yields are all off, what bond yields tell you is the price of money over time, right? Consuming today versus consuming later. So all of these things are rather perverted, and we're seeing mostly momentum plays. You're seeing the market, as we know, being led by the big heavy tech guys. You look at the S&P. One of the things to keep an eye on is the S&P versus the S&P equal market cap weighted, and how different the performance is there.
Oh yeah.
Right. I mean, that tells you an awful lot about what's really going on in this market. It's one to definitely be careful here, be looking for those topping signals, and make sure that you've got some protection on, or you have a plan for, these are the things I'm looking for, because we know at some point it can't go on forever. But as we all have experienced painfully so, this market doesn't make sense. It can't go on like this forever. It can go on so much longer than you would ever think possible. And
right.
how many advisors have just gotten killed because they were trying to be prudent, which makes this so much more complicated. But you need to know what it is that you're going to be watching to see where, as things are changing. Momentum is one of those things to really be keeping an eye on. Around the election, things are probably going to get very exciting. I mean, we probably have all seen what's going on there with the risk premium, with volatility pricing that's expecting some craziness there. That may provide some buying opportunities as well. But it's to have a plan, because this is going to get wild. Like what we saw back when the pandemic hit, is to have a plan and have a way to be able to execute without panicking and without having your clients panic, because there's no way we're going to get out of this without having a return to some sort of very intense volatility.
Yeah. Have a plan, have it systematized. Make sure you're not using your discretionary gut instincts as a financial advisor. The cover of Barron's this weekend, I thought, was awful. It talked about near-term retirees needing to come up with a new plan because of what's happened this year. If you need a new plan because of what happened this year, you're in a really bad spot. You need a new advisor. You got to have a plan. Like Lenore said, volatility is coming. Challenges will always come. Have a systematized plan and you will be okay. Lenore, thank you so much for coming on the show after not sleeping for 30 hours. We really do appreciate it.
Well, it's always a pleasure with you. I wouldn't miss it.